Hey everybody, Paul here from Stone Barn Portfolios. And we spend a lot of time talking about the concept and the ideal of a perfect portfolio, kind of a straight line that goes from the bottom left to the top right of your chart if you were to draw an equity line. And there are some features about that ideal that we want to talk about today. I'm going to spring a phrase on my friend Don from Georgia. It's persistent consistency. And we're going to take a look at some charts and illustrate that and talk about why it's so important to getting as close to this ideal of a perfect portfolio as you can. And we'll explain some of the things that we do in order to achieve persistent consistency. So, right after this. Don, it's good to talk to you. This is a day after Labor Day, September, the 3rd, 2019. And did you have a good holiday?
Sure did. Did not do too much constructive, but I put on a couple of pounds, so I guess I'd term that pretty successful. So.
Well, so yeah, it sounds like you did your job then. We actually had a really down time. We really didn't have anybody over or anything. We planned to use most of the weekend working outside and catching up on stuff that gotten away from us, and we did a good bit of that Saturday. Sunday we just took the day off. We were tired and figured I'd finish up Monday, but then it rained most of the day, so so I cleaned up my office. So and, I made use of the time anyway. But yeah, so summer's gone, and we are into the fall. Today, if it's all right with you, I'd kind of like to talk about something that it kind of fits into the idea that we put forth about the perfect portfolio, and why that's an ideal that is worth pursuing. And even though you can never catch it, you can't achieve the perfect portfolio, but you can get as close as you should get as close as you possibly can. And of course, you and I, this is the way that we structure our own portfolios. But what I'm going to do is, if you don't mind, I'm going to share my screen with you, and I want to talk about a feature of this. I'll tell you what it is as soon as we get in here. All right. So let me turn on the sharing feature here, so we're both looking at the same thing, and you let me know when you can see that.
Perfect. Looks like a straight line to me.
That's a straight line. Of course, the black line is the S&P 500 index. We're looking back that into 1999, and we keep this picture as an illustration of what a perfect portfolio should look like. You can see that, they starts right around the same place, it ends right around the same place, and if you wanted market-like returns, this is what you want your portfolio to look like. That straight line goes from the bottom left to the top right. It does not deviate. And you'd have, in this case, if you could have done it starting back in 1999, you could have had the same return as the S&P 500 without all of the headaches. And you and I have talked about this before. You and I talk to clients or prospects, and you say, what kind of return are you thinking you need or you want to pursue? And they'll say, well, market-like returns. And this is what they mean. They mean that red line, but what they don't say is they don't want all of this down in the middle there. So there's a feature here, Don. You and I are aware of it. I don't think we've ever tagged it before, so I came up with a name for it, and I kind of want to go over the idea that's behind this concept of a perfect portfolio. And the tag that I want to use is persistent consistency. And I want to show everybody what that means to you and me. So if you'll bear with me, I'm going to bring up a picture of one of the portfolios that we give subscribers, that we talk about with subscribers. This is a moderate portfolio that's based on the NASDAQ 100. It's this plum line here, a purple line. Again, we're looking at the S&P 500 is the black line along the bottom. And if you can see that this is by no stretch of the imagination, is this a straight line from the left of the chart to the right of the chart, but it's a lot closer to a straight line than the S&P 500 is. And so this is what we mean when we say it's an ideal to be chased, even if you know that you can't get it. So persistent consistency. In order to kind of illustrate this, I'm going to shrink the view on this down from, we're looking at about 16 3/4 years here. Up here, this tells us the total years that we can see on the chart. I'm going to shrink this down to about 3 years, all right? And very slowly as I drag this across, the chart changes, all the calculations update, and it's one of the things you and I like most about this piece of software is the way that it lets us kind of narrow in on different sections of history of the markets and see how things behave relative to each other, and gives us a picture of it. Now I'm watching the total years visible up there on the left, and when we get down to around 3 years, that's where I'll cut it off. I'm sure I won't get it exact, but we'll get close enough.
That's good right there. That's good.
There you go. All right. We're a couple days over 3 years, right?
Yeah.
Now, here's what I'd like to pay attention to is, again, now we're looking at 2003 through 2003, 4, and 5 is what we're looking at here. That's 3 years. And again, we're looking at that plumb line versus the black line. And you can see that there are times where the plumb line underperforms and other times where it outperforms. We're interested in these two bottom lines here. This is the NDX moderate portfolio during that 3-year period, and this is the market, the S&P 500. You can see that their total return is pretty much the same. And sure, you start right here and you end up here, and they're very close to one another. You can see though that the purple line gets nearly the same performance, but it does it with less risk, less drawdown. The market gives back 14% at some point in here, whereas the moderate portfolio only does about 9%. So for the return, taking less risk, that's a great thing, right?
Absolutely. So, Paul, I think that one of the major points here is that in the development of this, there was no optimization because we could, if we were going to optimize this, we could have done a better job than this. Yeah. This was a strategy that was built, and then we ran the testing on it. This is the testing parts of it. You can clearly see there's underperformance at times, and there's quite a bit of overperformance. If you go through this period of time here, we're underperforming a little bit, but if you start in this area, you can see that we absolutely outperformed significantly. So over this period of time, non-optimized and underperform at some point in time, but clearly our objective is met as you go from southwest to northeast.
That's right. And that's a really good point about it not being optimized. We were not after return. We were not trying to build a portfolio that essentially had return. We were trying to build a portfolio that was as close to that ideal of a perfect portfolio as we could get. And that meant that we were focused primarily on these risk numbers here, these maximum loss numbers. These are the ones that make it impossible to sleep at night if they're too high. And so what we're going to do, I'm going to slide this indicator across the bottom here, and what it's going to do is it's going to give us a moving 3-year window from 2000 to 2002, and we'll go all the way up to current day. And I'd like to draw your attention to not necessarily these return numbers, but to these drawdown numbers. And we were shooting for something that had less than 10% maximum drawdown. For you and me, in our moderate, the way when we invest moderately, we're willing to take that kind of risk, but not anything more. And so we want consistency in that number. We want that number to be persistently consistent. I know I'm going to mess that up, but I hope I don't say something wrong when I do it. You know,
it's pretty sophisticated for us Georgia people now, so you better tone it down just a little bit where we get the message.
I don't know what you'd say down in Georgia if you wanted to say it's maybe it drives a straight road. I don't know, but so let me show you what I'm talking about here, and I'll slide this. And what I'll do, let's start out by just going by 1 year. All right. And as I'm moving this, keep your eye on those two numbers. And you can see how performance changes. And sure, yes, we are underperforming. But look, our number hasn't changed. We've got again, we have slightly more risk in the market, but we don't care because 10 is our target. And we just don't want more than that. And as we get right here to beginning of 2004,
right there.
You can see again now during the next 3 years we kind of outperform the market with less risk than the market. That's what we're going for, and we have not exceeded our 10-year rate. The 7-8, it's a little less than 8. 8 is about where we started. We'll go as high as 10 if it does that for us. So I'm going to go and slide again here now, and I'm going to just keep on going. Now remember, on the right-hand side, pretty soon that financial crisis is going to sneak in here, and we start to see the beginnings of that here. When we were in 2007, we didn't know that was the beginning of the financial crisis. We just knew that was a pullback in the market, right? But again, here we are during that, even going into 2007, our drawdown is fairly consistent. That's what's important to us. That's what gives us that nearly straight line. Now, as we move more and more into that financial crisis in 2008, and we get to the bottom in 2009, which is right around there, now we can see again that the market has gone down 57%. During the same time, again, we've gone down a little over 9. And you look at this plumb line, and again, it's still moving from bottom left to top right. And even though there's a little bit of volatility in here, there's not more than we're willing to accept for a moderate portfolio. Okay, I'm going to drag on a little bit further. And how about if I sit this the left-hand side of the screen right at the bottom of the market, the financial crisis, which was March of 2009. All right, it's right there. All right. Now, what happened after March of 2009? The market took off, if you'll recall. You could see the black line. It took off like a rocket and came out of the bottom of that market up until April of 2010 before it had another big pullback. It took off again out of there. And then in 2011, back in July, I guess it was August actually, late July, early August, it had about a 10 or 12% drawdown in there.
I think it was a little more than that, because that was one of the most difficult times in our managed assets. 2011 was extremely difficult. I think we approached 20% or so.
I think you're right, because right there it is.
I remember those days pretty well.
I think you're right, and but again, in terms of consistency,
yeah,
and it being persistent during that time frame, the model it stayed under 10. It's well within. In fact, it's remarkably low, and that's an unusual period. But it really handled those risk periods here and here. We never lost more than about 6% of what we had had invested at any given time. Now I'll keep going here, and we'll get up to more recent periods. And let me get right up here. We're looking at 11, 12, and 13 now. Again, this 19% or 20% drawdown of 2011 still in there. But again, we are still, right in there, below our target of 10. And as we go, here's something that you and I have talked. Here's a feature. Maybe I'll ask you to weigh in on this. We're looking at here the 3 years between, let's say, March of 2012 all the way up to, I guess it's probably February of 2012 to February of 2015. That plumb line underperforms at times and outperforms at others, but roughly it's the same performance over that 3-year period. But back to your point about not optimizing, we did not say we want to outperform during every given period. What we said was we want our drawdown to be under 10, no matter what slice of the period we look at, no matter what slice of the history that we look at. So here, you would not necessarily have made a lot more money invested in the moderate portfolio than you would have just buying and holding the S&P 500 for 3 years. You might have been real happy with 16% and a 10% drawdown, buying SPY. But we had roughly the same performance, maybe a percentage point more, but we had 2/3 of the drawdown, 2/3 of the risk of loss during that same period. Again, this is the persistent consistency that you and I, this is what our portfolios were designed for. This is, I don't know if it's because we're both sitting here with gray hair and, we're old, we've been through too many battles, but, this was the thing that was one of our priorities, was being able to control risk, especially as we get into our later investing years.
Paul, I think that clearly, if we all knew that the markets were going to continue to go straight up, it would probably be less than candid to say that it's hard to outperform a pretty robust, straight up market. But I happen not to believe that. And can I move the screen just a little bit too?
Yeah,
I want to move forward to just a couple of these.
Hang on, I'm going to give you control of the board there. You go ahead and click, and I think you have it. There you go.
I want to move to a couple of these little. What I did is I moved to a top area. It shows that when you get to these tops, the moderate portfolio clearly outperforms. And if you move forward just a little bit further, I'm going to try to find another top in here right about it clearly makes a difference as you go forward. So if you measure from the exact lows now, you probably have more of market type returns.
Mm-hmm.
So controlling volatility, the controls are mandated for us. Mm-hmm. And we built it for volatility, and yet the compound return is the benefactor of having volatility control, because it's just one of those things. You just don't go down as deep into the holes. So let me go forward to another little top right here. Ooh, I'm past it. I'm sorry. I'm a little nervous this morning. But it goes to show you here, we just go across those valleys with a lot less turmoil. That makes us leave at a higher level, and it's just the way we built our little mousetrap.
That's right. It's been interesting as we've kind of explored a lot of the literature around low volatility. Of course, that it's academic literature, and neither of us is an academic. We're practical people, but I think we can take some of that academic research here and turn it into a practical application. There are several factors that you can leverage to give yourself an edge in the markets. One of them is momentum. Now, the problem with momentum is that it's usually late out of the gate. It's usually late to respond to drawdowns. It's usually in up markets, it's almost impossible to keep up with your benchmark. So we pair that with low volatility. Low volatility is another factor, another anomaly in the market that's well documented. And by selecting stocks that exhibit low volatility, we really control. I like your analogy of not digging yourself so far down in a hole, so that when things turn around, there's a lot less you have to climb out of than the market itself. Just looking at this 3-year period, the market had a 13.5% drawdown in here. So it's probably this period right here. From here to here is about 13.5%, I'm guessing. This is another possibility up there. But our portfolios did about 8.5. So coming out of an 8.5% hole versus coming out of a 14% hole is a very big difference. It means we're making new highs well before, you can see it right here. I'm going to turn on the crosshair so we can kind of draw this horizontal line here. If this was a high, then this thing made a new high here. You can see we were making new highs here, right in the middle of all that. When this thing rallied, we were making new highs. The portfolio was coming out of here. If this is a new high, you can see how the portfolio took off and was making new highs even while this thing was going down. So you put those two things together, and you get some really excellent results. You get this persistent consistency. Let's drag over to a time that might be easy to recognize. This was the fourth quarter of 2018. Again, in terms of consistency, we're still under 10%. The market itself was down 20. I should say the S&P was down 20% there. But with our consistency, again, even during that time frame where 17 and 18, this thing was going up like a rocket, because we built our portfolios to manage this. Our return during that same time frame was slightly better than the market, with half of the losses of the market. That's what we're going for. That's what we're doing, and I think that this perfectly illustrates our concept of persistent consistency as it exists as a feature of the perfect portfolio. And drag this back out here again, just so we can take a look at. Let's go back to the since that bottom in 2009, which is right around there. Again, we're right around 9%. That's our target. Less than 10. We're happy when it gets down to 6 over a 3-year period, but we're still real happy in that even looking at now 10.5 years, our consistency is right there. We're still right within our target rate for volatility. As we've done this live in our own portfolios, that has been the case. We've never been at more than this. Right now, our portfolios are within 30 basis points of new highs, while the market is off nearly 5% from its high. So that's what we're trying to do.
Down here in Georgia, we call it winning by not losing. So
yeah, that's exactly right. And that's a great way to say it. This represents quite a bit of an effort on our part, because we've spent most of our careers trying to figure out tactical strategies and other things. This is more about portfolio mixing, and the models or the components of it help each other out. Certainly not losing is more important than I ever thought once you take a portfolio and look at it over
over some of the rough ground that we've had to plow in the past, and we will in the future too. I think we'll be very, very well suited to identify these bad markets and probably to take advantage of them in some ways.
It's true, and they say, you know, your worst drawdown is always ahead of you, and we know that we may at one point exceed, you know, our 10% target. But one of the things that gives us some measure of peace and sleeping at night is the fact that as we look at any given slice of history in this portfolio, that even if we go back 17 years, we never got over 9, which is a big deal for us. This is how we build it. You're right. A lot of significant effort, and it was a major paradigm shift for both of us. And I guess you know, best we could say is you can teach old dogs new tricks. And you and I, we always were looking for this number first. Now, what are we getting? I'm not going to be happy unless I'm getting X percentage return. Now, I guess, you know, older, wiser, I hope, we are saying, look, we're not going to sit still for more than X percent risk of.
It's kind of a reverse thought process. You would always try to get the best returns with the least amount of drawdown to deal with. But we built the model for drawdown first, and the returns are just a function of the lack of drawdown. And that's kind of hard to twist around in your mind after a while, but it works. Got our personal money stuck right in the middle of it, and you know,
it's counterintuitive, isn't it?
Hold the test of time too, and that's something that's pretty hard for me to say.
It is. It's counterintuitive because all our lives, you and I have both been preaching, and we've both been taught that the more risk you take, the more return you get. And here, what we've learned and what we've implemented for ourselves is that by implementing low risk approaches, we actually we see higher returns. If you were going to go with less risk, let me turn this crosshair off again. It's annoying me now. But if you were to say, look, in order to get better than 7.5%, you'd have to take more than 50% max drawdown risk. And here we're saying, no, that's not the case. We're saying that by using diversification across strategies, by using multiple factors, which are proven anomalies in the market that over the test of time can give you an edge, and by focusing on risk primarily, we can create a portfolio that lets us sleep at night and still reach our financial objectives.
Couldn't have said it better, brother.
Righty. Okay, well, that's as much as I wanted to kind of go over today, unless there's something else you kind of want to. I think you still got control there.
You take the control back. I don't know how to do it, but anyway, I think this is the heart and soul of what we offer, and it's something that for people who are do-it-yourselfers who might need some help. And I would encourage you not to just buy all of the things that are out there today about you've got to be in the market all the time and you've got to hold 500 issues and things like that. There's a lot of that we basically take advantage of rather than being more diversified. We make every stock in our portfolio and bond mean something, and what it means, it must be oriented toward risk first, and the returns take care of themselves.
Yep. Again, I'm going to say right back at you. I couldn't have said it better myself. That was well said.
All right.
All right, my friend.
Okay, well, you have a good day, and I'll look forward to seeing you in a couple.
I'm going to do my best.
All right.
Bye.